Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And yesterday's volatility has spooked a lot of investors. So today we want to address the market volatility that we saw yesterday, where that volatility seems to have come from, what changes we have seen in the market as a result of that, and try to answer some questions as to how to position going forward based on the data that we're currently seeing. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities, and it is not and to buy or sell any securities. Sorry, one second. It is not, I apologize. It is not a recommendation to buy or sell any specific securities. So just a little bit of housekeeping here. This Thursday, we have a market outlook session. I'm going to be doing a little different session here this Thursday. We're going to do a little educational session where we're going to effectively put on some paper trades together, and we are going to track them over the next few weeks to highlight the difference in strategies that you can deploy when you have a bullish, bearish, or neutral outlook on a specific stock or ETF. And more importantly, as we track them over the next few weeks, show you how we go about thinking. How do we go about thinking through when we would decide to hold on to a trade, when will we decide to take profits or cut losses? A lot of investors have been asking us those types of questions, and we want to help address them by doing some educational events on that. So that's going to be coming this Thursday. Really looking forward to doing that. And this Friday, we are doing our next thematic investment series on the future of water. Scarcity of water is something that many of us don't really think about too much in America, but other countries, and especially as climate change becomes more and more of an issue, scarcity of water is an issue that is quite important for the sustainability of the global population. So we want to talk a little bit about the problems that many countries face on this front, even in the United States, and the companies that solve some of those problems. So that's what's coming up the rest of this week. And just a little bit of also housekeeping. I am out next week, so we're not doing any events next week, but I will be resuming this the following week here on March 9th. So we'll send out a schedule before so that you'll know the full March schedule of all the events that we will be hosting. But I'm really looking forward to doing this one this Thursday, where we're going to put on some trades together and follow through those trades here over the next few weeks and show you the thought process that we have to decide when we decide to hold on to a trade or let go of a trade. So in today's session, we're going to start off with our major market update. This is going to give us a big, broader picture from a macro perspective, where we're seeing strength, where we're seeing weakness, and how that affects our decision in terms of understanding our outlook for the broader markets. Then we'll take a look at the rates market, where we're starting to continue to see some substantial moves from fixed income investors and shifts that started to happen here over the past couple of days that did change our views a little bit as far as how rates have changed. We'll take a look at some of the commodities as a result of the change in the US dollar. And more importantly, we'll take a look at the sector rotation data. Sector rotation is at the core of my thesis as far as how the sell-off is being contained and what my directional view on the broader market is going to be based on the sector rotation data. And then we'll share with you a few ideas. And these ideas are designed to provide a template for you to find opportunities here over the next few days, because I think that just putting out a few ideas is not particularly fair. I think there are far more ideas than just a few, so I want to use them more as templates to show you my way of thinking and how I plan on finding some opportunities in the markets here over the next few days. So with that, I want to help answer a question that we've been getting over the past couple of really past 24 hours, which is really, are we watching the start of a larger correction? We've been talking here on the market outlook sessions here for the past probably close to 4 to 5 weeks now, talking about markets are reaching overbought conditions. We're starting to see a lot of exhaustion from especially some of the tech stocks. We're seeing just a lot of excess in the markets and a lot of investors concerned about a potential pullback here. So the question is, are we seeing the start of what is a much larger correction here in the broader markets? And so my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And I want to share with you my technical charts, my research that informs my decisions as to how I'm viewing the current volatility that we saw in the markets yesterday and what my outlooks are from as a result of that. So we'll start off with the S&P 500. And when we look at the broader picture of the S&P 500, we've been talking about higher highs in price not being confirmed by price in momentum or higher highs in momentum. And we started to see some of that bleed off a little bit. But in the context of the broader equity rally, the sell-off that we saw in the S&P 500 is, I wouldn't even call it a sell-off because we're not even below the 21-day moving average. Granted, we are about to open up below the 21-day moving average, but we're still within the channel here of the 21-day moving average. If we break below the channel, then I certainly would think that we could head down to the 370 level and potentially 357 level here to the downside, which is the September 2nd highs that has been a solid form of support or resistance here in the 357 zone. But those are our two primary targets here to the downside if this 21-day moving average in this zone does not hold. So far, it has held, and largely the S&P 500 has not seen a broad-based sell-off here. Where we have seen that sell-off is in the NASDAQ 100 index, largely growth stocks, growth technology stocks that have been where the sell-off or volatility has been contained within the the Qs or the Nasdaq 100 breaking below the 21-day moving average channel. This certainly starts to put 312 and 303 to the downside into range here to the downside. So 312 is here, 303 is the September 2nd highs. Those are our two potential downside targets here to the downside. It's hard for us to see any visibility into which one of these targets we're going to hit here. If anything, I think over the past few weeks, we have seen sell-offs tend to be fairly short-lived, even though we are expecting that this market continues to sell off a little bit more today, especially in some of the tech stocks. I think a pullback to 313 or 312 is more likely than a pullback to 303, but we'll have to see that over the next few days. But I want to show you, something that really is interesting, which is the fact that small caps, after on a day of what would look like was going to be a pretty ugly day in the markets and likely going to be an even uglier day today, small caps was higher on the day, up about 0.6% yesterday. That is very interesting to see that small caps are continuing to rally, meaning small caps have not been spooked by the sell-off that we've seen in technology stocks. And the RSP, the equal weight S&P 500 index yesterday, making a new all-time high. Didn't close at that all-time high, but making an intraday all-time high while technology stocks got pummeled yesterday, largely unprofitable technology stocks that got pummeled. So if we go back to over the past few weeks, we've been talking about excess. We've been talking about how markets have been reaching overbought conditions, how we're seeing signs of exhaustion. Well, guess what? We saw the resolution of that yesterday. We saw many of those things resolve themselves within roughly a single trading day. Now, again, I do think that you're likely to see some more weakness here today, potentially even for the rest of the week. But the excess and the fear from investors that we have seen over the past few weeks of excess and overbought conditions and market topping conditions are being resolved. And the rest of the market, the small caps, the broad-based S&P 500, the equal weight index is breathing almost a sigh of relief from that and rallying as a result of that. And that leads me to believe that, at least from a high-level macro perspective, the sell-off that we saw yesterday was a good thing for the equity rally, because equities cannot just go up in a straight line. They must correct and consolidate before they can continue moving higher. And that's what we're starting to see, is that consolidation and bleeding off of that momentum in the one sector that many investors were concerned about. We started talking about, is this a 1999, 2000 tech bubble? The valuations are the same as we've seen in those conditions. Well, the market is responding to that. The market is selling off some of those stocks. And when we dive even a little deeper here into the other sectors, you'll see that even more. But value versus growth. We've been talking about this for a few weeks now. Value underperforming growth for a long period of time. We saw this bottoming formation and look like what looked like it was going to be a correction here and a breakout higher here and completing this reversal pattern here. So far, that reversal pattern on the verge of completing and breaking out here. It hasn't broken out yet. So again, I want to warn investors because we saw it here and we saw it here, and both times it failed, but we're back here again for a third time. And the question is whether this finally manages to break out and value starts to outperform growth, or we're starting to see, just growth bleeding off some momentum, but then continuing to be strong here. I'll be honest, I'm not going to make a call here. I'd rather wait for the data to show me at the moment, because I thought for a few times that this was going to break, and very well it could break, but I'm not here to make that call. I think I'd rather see the data play out. But this is one that I think is very important to pay attention to understand as we expect perhaps more upside here for equities for the rest of the year. Where do we want to position ourselves, into more value stocks or more towards growth stocks? So far, growth is still the place to be, but and I don't think the trend from yesterday or from the last couple of days is enough to call it a trend, but we're certainly seeing some of that rotation right now, and we're seeing in globally, we see it in EEM in emerging markets, but again, that sell-off largely contained in the broad sense of the bigger equity rally that we've seen in EEM from $30 to 55. The pullback here of just a couple of bucks is still a relatively minor correction here, and historically have provided us with buying opportunities rather than the start of a major sell-off here. So that's still the thesis that we have here for today, is that the rise in yields that have caused this cap on the equity rally here still has some more upside here. So if we look at the 10-year yield, we moved from about 325 basis points at the end of 2018 all the way down to 50 basis points here earlier this year, and we've retraced just shy of 38.2% of the fib level, and that 38.2 is 155 basis points. That's our primary target here to the upside. So we're right now at 136, so we still have another 15 to 20 basis points move here to the upside. So rates continue to move higher here. The one thing that I want to point out here is TLT, 20-year Treasury bonds, moving from 111 to 171. That's roughly a 60-point move. We've retraced exactly half of that. We've sold off 30 points from that 171 down to 141 here. That's the 50% retracement level. So right now, the question is whether the 50 retracement level holds, or more likely, in my opinion, the 618 fib level holds, which is 134. As you can see, if you look back, 134 has been a pretty major level to pay attention to. It formed resistance here. It formed multiple levels to support here. So 134, in my opinion, is a more significant level, and that would correspond roughly to 10-year yields rising to about 150, 155 basis points. The rally in Treasury yields we've seen so far, or the sell-off in Treasuries rather, which increases yields, speaks to two things. One, simply just fixed income investors having confidence in the equity rally or the economic recovery that we're in, and selling off bonds that are safe bonds. They don't need to find safety anymore. That's why they're selling Treasury bonds, and they've been buying riskier assets with that money that they've sold Treasury bonds with. So that speaks to the confidence in the economic recovery, but it also speaks to inflation expectations, concerns that inflation in the future is going to be higher, and Treasury bonds that are not going to protect you against inflation, that's where you're going to shift assets away. So it's a combination of inflation expectations and the economic recovery that has really sustained a fairly strong sell-off in Treasuries. And the one thing that has shifted a little here over the past few days, and a few days is not enough to make a trend, but we've started to see the sell-off in Treasuries, but also at the same time, we did not see that convert into buying of riskier fixed income products like LQD and HYG. We're starting to see high yield sell off as well. And this again leads us to believe that it's the rally that we're seeing right now from treasuries or treasury yields is less so because of the economic recovery or confidence in the economic recovery and more of an inflation concern. Because when you see a sell-off across the risk spectrum of fixed income, that leads us to believe that this is more inflationary rather than just a boost of confidence in terms of the economic recovery. Because if it was simply just based on economic recovery, you would sell off treasuries and you would buy high yield bonds. But when you sell high yield and treasuries, that means that we have more of an inflation concern here. So that is something that has changed a bit over the past few days and very important to pay attention to, because inflation concerns also, has other ramifications for risk assets that we are continuing to hold. So when we look at assets priced in US dollars like gold, we started to see a little bit of support here. And a lot of investors have been asking, why has gold sold off while the dollar has weakened here? And that's a really good question. And part of it is because gold has not provided the defense of inflation. It has not provided a safe haven asset here for riskier assets, and investors simply selling the dollar have found better opportunities than long gold. But it is near some major support level here around 166 or so, 165 or so, which has been a major support or resistance level for quite some time. And the question is, how is gold going to resolve itself from this triangle that it's formed after breaking out above this 166 level? Is it going to continue moving higher, or is it going to break lower here? A break lower here certainly puts gold substantially lower here. So this is one that we're paying attention to. But if we look at the US dollar continues to weaken here. We talked about a potential reversal here that did not complete itself. It's more likely to looking like that consolidation pattern after a period of weakness. It's found an equilibrium, and the question is whether it's going to continue moving lower. Now, with inflation expectations continue to pick up, that certainly points us to potentially a weaker dollar here going forward. So looking at, zooming in a little bit into the equities themselves, this is really what drives my thought process behind the fact that I don't believe what we saw yesterday is the start of a major, larger equity correction. And it's based on the sector rotation that we're starting to see. We saw a strong sell-off in technology stocks, and arguably, if you look within technology, a lot of this, most of the severe sell-offs that we saw yesterday were contained in stocks that were unprofitable. So we're talking about the growth stocks that have seen strong revenue growth at the expense of profitability. We saw a huge correction in those types of stocks. And we also saw a lot of stocks that were trading at very, very rich valuations, like solar stocks that sold off heavily yesterday. And again, that's where investors have been concerned about excess in the markets. When we made the comparisons of valuations to 1999, 2000, these were the types of stocks that were contributing to that type of rich valuation. So when we see that bleed off in momentum in those stocks, the rest of the market that are part of the economic recovery actually rose as a result of that. Again, it almost feels like the market was breathing a sigh of relief, saying this concern that we had in the markets seemed to have resolved itself in some degree. And I'm not saying that yesterday's sell-off was enough of a sell-off. I think that we might see a further sell-off here in some of those stocks here for the rest of this week. But the rest of the market, materials, making a new high, making a new relative high here, breaking out above some resistance levels and starting to retest those all-time highs. That is constructive, in my opinion, to see that rotation out of these higher growth sectors into more recovery sectors like materials, like financials. We saw that we think there's a little bit more upside here in treasury yields. I will point out here in financials, something that we pointed out in technology here over the past few weeks, financials making a new higher high did not confirm that in momentum. But as we saw in technology stocks, that could very well continue on for a period of time before you see a bit of a correction or consolidation here. So first, negative divergence here in financials. In my opinion, there's still potentially some more upside here in financials because we expect yields to still continue to climb for a little bit, and we expect that rate curve to continue to steepen here a little bit here as we saw those targets here in TLT. Energy still continuing to break out higher here. XLE breaking out to new all-time highs. This is also on the back of the changes in fundamentals that we have seen as a result of the storm in Texas that has constrained supply. And the other thing I want to point out here is that energy shares starting to see some exhaustion here as well. New higher highs in energy shares, but has not been confirmed by momentum over the past two higher highs. So I do think that there is some limited upside here or some concerns to go long energy at these levels because the risk to reward ratio at all-time highs and this negative divergence, in my opinion, is not particularly attractive. So when we look at the best performing sector, XLE, losing ground here, losing strength here, that is, the rotation that we're looking for in this broader equity rally. And especially when we see rotation into financials, into materials, and even what I call a stealth rotation into sectors like staples. Staples flat on the day yesterday, while the rest of the market sold off here. So that deceptive slight rally that we've seen in staples, and similar to as we've seen in healthcare as well, this stealth rally that we've seen in healthcare, that is, again, constructive of the equity rally. And lastly, industrials actually breaking to new all-time highs yesterday. This is something that is not typical that we see in a market sell-off or part of a major market correction. So with that type of sector, with this type of sector rotation that we're currently seeing, this is what leads me to believe that the sell-off that we saw yesterday actually provides a potential for the markets to breathe a sigh of relief and actually continue moving higher going forward after we resolve some of these concerns of excess and overbought conditions that we've seen in equities. So with that, just to set up some ideas, and again, the setups here are more for as a template rather than specific symbols that I think you should focus on, because we have seen many techs. So the sell-off yesterday was contained mostly in growth stocks that were largely unprofitable, and many of them in the tech sector. So when we look at the tech sector is very broad. You have plenty of very profitable and sustainable businesses that are getting caught in the crossfire. And a good example of that is Microsoft. And I think Microsoft and Apple are great examples of this, where you have arguably stocks trading at rich valuations, but not at the ridiculous valuations we've seen in many of the growth stocks that are very profitable, will likely remain very profitable, and have continued to see revenue growth despite the difficulties of the broader market. These are the stocks that you want to look for some opportunities in, because stocks like Microsoft, Apple, that are starting to pull back to some major support lines, especially as these shares bleed off some of that momentum. So for Microsoft, somewhere in this 220 level, 225 level, these are potential better opportunities to go long from a risk reward perspective than going long near all-time highs. So that's exactly how I want investors to think about, in tech stocks. It's a broad category. There are plenty of names that you might like from a fundamental perspective that you didn't feel comfortable buying at all-time highs, that this correction, as they get caught in the crossfire, provide potential opportunities to seek long exposure in stocks like Microsoft, Apple, and there's a whole list of names. And each one of us may have different thesis as to which technology stocks are fundamentally sound and are being caught in the crossfire and have opportunities here over the next few trading days. Like I said, weakness can continue today, can continue tomorrow, perhaps for the rest of the week. But looking at the sector rotation we see in the broader markets, I think that sell-off will be relatively contained, and that sell-off provides the opportunity to potentially look for some long opportunities in these names. On the flip side, you have stocks that will continue to do well, especially as the news from the vaccine continues to actually outpace our initial expectations of the vaccine rollout here. Many of us have seen the headlines of 500,000 deaths here in the US, but that is to some degree overshadowed by the acceleration that we've actually received in terms of vaccine rollouts. The expectation before was that perhaps by the end of the summer, most of the population would be vaccinated. We're now estimating towards the beginning of the summer and potentially even accelerating that even further. So that has led a lot of these travel stocks to continue to rally here. And many of you know, for me, Southwest Airlines represents one of my favorite plays in terms of travel stocks, but we're also long stocks like MGM and Norwegian Cruise Lines. These types of names I think have some further upside here. So Southwest Airlines, again, is really more of an example rather than a specific stock that I'm trying to suggest. But thinking along these lines, looking at some of these travel stocks, looking at the ones that you think are fundamentally sound, that will come back sooner than perhaps some of their competitors. For me, Southwest Airlines represents a better airline, will likely recover more faster than Delta, American, and United. Norwegian Cruise Lines, one of the better cruise operators. That's the line of thinking that I think you need to have in the market conditions that we're in, because there are still upside opportunities in many of these stocks, especially these travel stocks. And then looking at sectors of the market or segments of the market that are still trading at what you would consider far more reasonable valuations. And financials is largely that group of stocks that are trading at valuations nowhere near 2008, 1999 valuations, that have further upside because we expect yields to continue moving higher. We expect the rate curve to continue to steepen. And despite those metrics being at all-time highs, some of these banking stocks have not broken out to new all-time highs, like Morgan Stanley, that is now at a double top with a potential bullish breakout here. I've talked about a lot of bullish breakouts here over the past few weeks. Many of them have broken out here over the past few weeks. And again, Morgan Stanley represents one of them in the markets that we're in. Hilton was one that we talked about last week. JPM, these are all stocks that had reached these type of double top breakout potentials and have now broken out higher. And I think stocks like Morgan Stanley represent a group of stocks that you might want to pay attention to here going forward. So with that covers what I wanted to share with you here today. Like I said, a lot to cover, a lot of volatility in the markets yesterday, and rightly so, being a little concerned about that and seeing, is that going to bleed off into the rest of the market? From the data that I've seen so far, I believe that it's likely going to be contained in the sell-off within this week, and I think actually provide some buying opportunities in the week for those technology shares, especially if you are selective within that group, and at the same time, providing a bit of a sigh of relief for the broader markets that were concerned that the excess in the market that was going to continue and perpetuate itself to lead itself into a major market sell-off here. I think the rest of the market is breathing a little bit of a sigh of relief and being able to move forward from that. So with that covers what I wanted to share with you. I hope that this was helpful in helping you start off your day and giving you a better understanding as to what's currently going on. And please stay safe. And just again, a quick bit of a housekeeping here. Next week, I am out next week, but I do want to thank everyone for continuing to support us and being a part of this group. I, again, hope that you guys find this useful. I'll be back here this Thursday to do a market outlook session. Like I said, we're going to change things up a little this Thursday, do some paper trading with you, show you kind of the thought process and walking through a trade with you guys. Friday, we're going to be doing the thematic investment series for all of our members to give you a sense for our thoughts on long-term for the future of water. And then next week, I am taking 1 week off, but I'll be back here the week after on March 9th. So with that, thank you so much. I hope you guys have a great trading day, and I'll send out the recording to you guys here in about half an hour or so. Have a great day.